Hi, this is Jim Pearce, Chief Investment Strategist for Personal Finance, with a weekly update on Friday, August 16th, 2024. Now that the Japanese yen carry trade drama appears to be over, Wall Street is looking for something new to worry about this week. It did not find it in this week's retail sales report for July, and I have the report open here for you to see. And as you can see right here, this top line, last month retail sales increased 1% over June, which was far higher than the 0.4% gain widely anticipated. Wall Street could also find nothing wrong or to complain about in this week's labor report, which reflected fewer initial jobless claims than expected. So here's that report, and you see the very first sentence. The advanced figure for seasonally adjusted initial claims was 227,000, a decrease of 7,000 from the previous week's revised level. Those two data points come on the heels of the Consumer Price Index numbers for July, which showed a 0.2% increase in July and a 2.9% gain over the previous 12 months. And excluding food and energy, those two figures were 0.2% and 3.2% respectively. So here's that report, and you can see the subhead here, CPI for all items rises 0.2% in July. So those three data points suggest the economy is still strong while inflation continues to come down, albeit slowly, but coming down. That is the soft landing scenario that the Fed has been working towards all along. And just like that, fears of a recession that might trigger a stock market crash dissipated into thin air. With that out of the way, all eyes are once again on the Fed. However, the Federal Open Market Committee does not meet for another month, so the next 4 weeks will be filled with speculation as to how big of a cut to its policy rate it is going to make at that time. Now, last week, while the economy appeared considerably weaker, a half-point rate cut was priced into bonds. On August 5th, the yield on the 10-year Treasury note dropped below 3.7%. So here's year-to-date the yield on the 10-year Treasury note, and you see over here where I have the crosshairs, that's last week. Rate intraday dropped below 3.7. Now today, as you can see here, that yield is back to 3.9%. So a quarter-point rate reduction seems more realistic now. At the same time, the CBOE Volatility Index, or Fear Index, dropped back down below 15 today after soaring above 65 last week. And here's the year-to-date chart. You see this huge spike last week, which, by the way, as I said last week, understates it because that reading there is the closing value last, I guess it was last Tuesday of, say, 38. But that day, it was almost twice that temporarily. But now you can see way over here on the right, it's really back to its normal level. In short, Wall Street is no longer hedging against a recession. Instead, it is now anticipating a stronger dollar, as evinced by the price of gold reaching a new all-time high today above $2,500 an ounce. And here's year-to-date price of gold. Look way over here to right, and you see this little surge up here. But yeah, gold is higher now than it's ever been. So if you got jewelry or something you're thinking of selling, this may be a good time to do it. Now, at the same time, the dollar has increased in value against most major world currencies. So here is the dollar versus, the euro versus the dollar, and we'll get over here to the chart. And again, not a big difference, but you can see, at the start of this month, you only needed like 1.08 euro to buy a dollar. Now it's 1.1. Not a huge difference, but it's the direction that counts. So Wall Street is once again buying stocks of all sizes, another sign that it believes the economy is healthy. This week, the SPDR S&P Midcap 400 Trust and the SPDR S&P 600 Small Cap Trust gained ground, as has the Invesco S&P 500 Equal Weight Trust. So here's the midcap version of the S&P 500, and you can see dropped down on pretty far there on August 5th, but since then a nice rebound. Here is the S&P small cap, 600 small cap index, again also bottoming out on the 5th, come back. And finally the equal weight S&P 500, which as its name implies weights all of the stocks evenly. And we'll get to the chart here and I'll show you year to date. You can see again same pattern, down on the 5th and now almost fully recovered. I don't know how long it will last, but the stock and bond markets agree that the economy is once again back on solid footing. Of course, that could change quickly if a new data point emerges that suggests otherwise. But until that happens, the general direction of the stock market should be upward. And that's this week's update, and I look forward to talking to you in another week. Thank you.